Hi, I'm Lynn Adams.
I'm Justin Gross.
Welcome to this edition of Video Insight. This is our third quarter market update call, and nothing we're going to be talking about in this call is intended to be investment advice. It's really just designed to be educational in nature. So with that, we'll get started. I think the first thing that we probably want to talk about in our call today is really just the state of the markets. You know, the world returns. It's been a good year in just about all the different market spaces. We'll kind of give you a quick rundown here. If you look at the chart that we've provided, what's leading the pack this year in terms of returns is the emerging markets. They're up 18.6%. Followed behind them is the developed markets. These are the non-U.S. Markets that have been around a long time, not necessarily in the developing nations, but more like the UK and the European region. Those are at 14.2. The U.S. markets, as a proxy for the U.S. markets, the S&P 500 is up 9.3% year to date. Russell 2000, which is your small cap stocks in the U.S., are only up 5%. Most of the hedge fund composites are up 3.3%. Interestingly, bonds are still up this year, 2.3%. Interest rates been moving around a little bit, and then the commodity index has been down around 5.3%. So for the most part, most pieces are up, some up double digits. In the U.S., small caps lagging, which you remember small caps was one of the better performing sectors over the last couple of years, so that reversion to the mean is still at work in that particular area of the market.
As well as domestic versus international. For a number of years, it's been all domestic. That's the best place you could be. So it's kind of a welcome change for us, seeing the international come alive as we've maintained diversification to those assets.
Right. Yeah, for sure. You know, a lot of people have called this the Trump rally. A lot of the media has connected the timing of the market moving forward back in the fall into the spring to the election, which, you know, I think is interesting. Really, if you look carefully at the markets, it's always going to be about earnings. If you look carefully at this slide here, this is showing you the analysts that follow all of these S&P 500 companies and their specific views of what those companies are going to do in the next 12 to 18 months. And what you can see here is that operating earnings are increasing. And they're expected to continue to increase really through the end of the year and into next year. I think that the media giving credit to, you know, the Trump political situation is a little bit misguided, not necessarily that doesn't play into it in investor confidence and things of that nature, but earnings are improving and the markets are improving. A big part of that earnings picture is still actually energy. You know, energy has been an area that has really been in trouble for a number of years because we had so much energy that we created here with fracking stuff that last 7 years or so, that the price of energy globally went down, and so the earnings from those energy companies has fallen. But in the last year, it's really stabilized, and that stabilization of energy prices has actually allowed energy earnings to be a contributing part in a meaningful way to the S&P 500. So it's not only an energy story, but it is a big part of why why the S&P 500 is better this year, because energy's been consistent.
But and we'll talk more about this, but it's important to always note these are estimates.
That's true.
If it were a given, you know,
right.
but these are estimates, so there's a lot of things that can happen.
Yeah, if we suddenly had a worldwide surplus of energy and energy prices fell, well, that would impact the markets in a negative way because of energy earnings being on the downside. The question that we get a lot, probably the biggest question, is the market too high, right? We're trading near all-time highs. You see a lot of noise, political noise that gets people a little spooked from day to day, but you don't see the market selling off to it. And so the question is, well, if it's so high, why isn't it showing some signs of weakness when we get the different, inputs that might scare people a little bit about the political process or things going on there? But the market is held steady, and I think the reason it's held steady is that it is not necessarily too high. I wouldn't go out on a limb and say it's cheap, but if you look here at this chart, just the price to earnings ratios, the amount that people are willing to pay up compared to the earnings that are being created that year from a company. At 17.5 next year's earnings, that is a slightly higher than long-term average price to earnings ratio, but it's not excessive, right? It's not like it was in the 2000 era, people paying 22, 23, 24 times earnings. And then also you can look at the little chart that's embedded in this graph and see there are other measurements that would represent, that maybe we're not overvalued. The dividend yield compared to the bond yields out there is a good number. there's things in here that you can't just look at valuations from a PE standpoint. There's other measurements as well. So the long and short is, I think we're probably not cheap, probably a little overvalued, but we're not looking at an imminent collapse, right?
Yeah, some people might throw the word out bubble. It doesn't feel like a bubble.
Right.
Maybe elevated, but the common sense answer to is the market too high is, well, what happens next? And
Yeah.
that's what you don't know, right? So.
And there are sectors within the S&P 500 that are more frothy than others.
Right.
I mean, real estate's getting to be pretty high when you measure its valuation techniques. It's pretty expensive, but at the same time, energy is extremely low.
Right.
So there's different pieces, and this is where a good, stock picker or manager that's invested is going to navigate having overweightings and underweightings in different sectors to try to outperform the market. This is the environment that they tend to be able to do that.
Right.
One of the big pictures that I think is important that we have to look at, we've talked about it several times in our programs and calls and events in the past, is this unemployment scenario. So one of the things that's really interesting in the last 14 to 18 months is that we are seeing our labor force participation rate actually improve. For an extended period of time, we only had about 60% of our total eligible workforce actually interested in working. I mean, according to the way that they collect the data. And we're seeing that that is actually coming back in the right direction. So we're seeing some of those people re-entering the workforce that had chosen not to work over the last few years. I think that has to do with a little bit of wage inflation. I think if wages are going to be a little higher, you're going to tempt people to come back to work more that maybe weren't so interested in working for the smaller paycheck. And I think just operating at full employment for those that are actively seeking work is creating that wage inflation. Right. So this is a good sign for economic growth. We do have to remember that if you look at the number of people retiring for the workforce permanently, the aging population, we still have a very big uphill battle. But at least for the time being, probably the next year or two, we might be able to work off this other category a little bit and get a few more bodies back into the workforce and potentially get a little bit more out of our economy. Okay, so let's switch gears for a sec and talk about worldwide growth. Okay, now remember, the S&P 500, about 60% of the operating earnings of those 500 companies come from overseas, selling goods and services outside the U.S. This is a heat map. This is a World Manufacturing Index heat map. And as a region goes from red to yellow to green, basically it's saying that that region is now manufacturing more. There's more demand for manufactured goods in those regions. This particular indicator has been a great leading indicator for the markets for pretty much my entire career to help give you a direction of where the markets might go next. So at this particular point in time, you can see incredible amounts of green, baseline above 50 in probably 2/3 or 3/4 of the world. So this is showing us that outside the U.S., the world markets, the world growth, the world economy is improving. And I think our companies, the U.S. S&P 500 companies, and sometimes some small and mid-sized companies too, are actually capitalizing on that. So it's creating a benefit to us, but not necessarily as strong a benefit as the improvements in those regions.
Yeah, there's always, in every single country, statistics and studies have shown kind of a home country bias. Mm-hmm. So we're focused on what's happening here, right, and that happens all over the world. But it's important to remember we're not bigger than the rest of the world.
Right.
So if the rest of the world's improving, that not only helps them, but it helps our market and our companies as well. So a lot of green. The green's good in this picture.
A lot of green, and you can say, well, why is that? And a lot of it's things such as, they've adapted to the changing energy landscape. They've adapted into the new pricing for natural resources. A lot of the European countries have had a lot of challenges trying to figure out, is the euro going to stay or is it going to go? And of course, there's been a lot more clarity as to which nations are going to be committed to it, which ones aren't. I think just the general time has passed and elapsed that there's been recession and now the world is recovering. So I think this is a good thing. I think this is more the reason that the U.S. markets are healthy and strong, more so than any political reason. I think the world economy improving is really giving our corporations more profits, and I think that's showing up in our stock market prices. Now, the flip side is we have a different heat map now, the inflation heat map. Now, we've not shown this one before, but when you have accelerated growth and you have low interest rates, it's a formula. The outcome is inflation, right? Now, the question is how much inflation is a good thing, right? And then as an investor, what assets do we want to own when we have inflation, right? So we're working through trying to determine on our end what changes do we want to make to our portfolio so that we can participate in the inflation assets, but we also want to help people to recognize that that dollar maybe is not going to go as far with purchasing power in the next little bit. And it really, in the U.S., will be determined how fast the Fed raises, how fast the world bond market adapts to this inflation data, and let bond prices go up, or excuse me, bond yields rise to cover that inflation issue. But it is noteworthy. I mean, there's half the regions in the world are now experiencing accelerating inflation, right? So that's something we haven't seen in a long time.
Right.
Talking about rising rates. So many of our clients, many of the investment universe own a lot of bonds. The last 10, 15 years, we're 38 years into a bond market rally. So the last 10 or 15 years, it's been sort of the category that people have had a lot of comfort in having a lot of bonds. Now we know if interest rates rise rapidly, bondholders can get hurt because the values will go down. The question becomes, a lot of people have started using stocks in lieu of some bonds because the yields are so low and the threat of rising rates is there. But the question becomes, what happens to stocks in a rising rate environment? Now, economics will tell us sort of at a basis that if rates rise, generally that's not good for stocks. That's how I was taught back in school. It's
kind of the rule of thumb.
The rule of thumb.
Yeah.
But if you really dissect, well, wait a minute. What about if it's rising from a low rate to a slightly higher rate versus if it's rising from a medium rate to a very high rate? So this chart here, is the little red line there, is showing every time the market had a rate increase that was going from something under 5% to staying under 5%, the little scatter charts show the next year return in the market, the stock market, and then everything on the right-hand side of the red line shows interest rates in the marketplace went up, and they started above 5 and they went higher. And I think this shows us a very interesting sort of asterisk, if you will, to the long-standing rule interest rates going up hurt stocks, to say, wait a minute, if they're under 5%, when they start rising and they, at the end of the rise, they're still under 5%, that's actually been good for stocks.
Right. A little bit counterintuitive, but a neat kind of statistic there.
Well, and this is real data points too,
right.
So it's not just sort of a hypothesis, this is actually historical data.
Yeah.
So I think that for those that feel that rising interest rates will derail or hurt the stock market, I think there's some truth in that hypothesis, but I think it comes when interest rates start above 5%, right? And we're at between 1.8 and 2.2 on any given month right now, so we're quite a ways away from that 5% number. I think that's kind of interesting.
That's what history shows.
Right.
And now that may change, but
right.
That's what history shows on this chart.
But it's funny, I mean, most economists, like big picture, interest rates go up, what happens to stocks? The default is, well, it'll hurt stocks.
Right.
But I think it matters of where they start, where they finish.
Yep.
So we do know that with rising inflation, and we know with the labor markets changing, we're going to see some changes in the future, right? Because we don't have an endless labor pool. So when we get to the pressures of inflation that we can't combat with having the labor force participation rate going down, then we're going to have real inflation. How we're going to fight it? And I think as the Fed has to pull out new tools that we haven't seen in over a decade, and I think as the market analysts have to deal with, with inflation assessments versus deflation assessments, I think we're going to get some uncertain outcomes, and the market does not like uncertainty. Like that is the number one cause for market volatility is uncertainty, right? We don't know what's going to happen tomorrow because of what we're doing today. So we want everyone to continue to be mindful that volatility is normal. Now, for those of you that have the chart that we sent, I want to point out that in the last 7 years, really last 8 years, our Federal Reserve System and monetary policy has really worked to underscore keeping volatility low, because they've just provided unbelievable liquidity whenever the markets were even remotely getting antsy, right?
The old phrase was good news is bad news because here comes the Fed.
Right,
They're propping it.
That's right. But remember, before 7 years ago, we didn't have this extreme monetary policy, so the markets would accelerate forward to maybe a point where they're a little bit too high, and then people get excited, and then something would turn and they would go down a lot. But volatility is normal. I mean, minus 10, minus 15, minus 17, minus 20, minus 30. Our history of the markets is riddled with these minus double-digit intra-year results, and that is truly normal for the market investor, right? What we've experienced the last 5, 6, 7 years isn't so normal. So we want to make sure that our clients understand what normal really is, because we will revisit normal once the Fed gets out of the monetary policy easing business, which they're working on now. And how are we going to deal with that on an investment side? And we feel like, obviously, with our defined risk strategy and having stop losses and having the ability to have investors have dry powder when we get volatility, all those things will help us to improve returns, as that's our goal. But we don't want folks to be lulled to sleep and think, oh, there's no risk, because there is risk in any of these financial markets, right?
Yeah.
We're 99 months into the current bull market. We are, I think, 15 or so months away from being able to say we're in the longest bull market cycle in the history of our markets. So this is an aging bull, right? This is not something that we see can go on and on and on indefinitely. And so, again, giving us reason to believe that we need to expect volatility, we need to expect the potential for a recession in the next couple of years. We don't know what will be the trigger, but we do know that we're almost 100 months in, and next summer, next fall, if we haven't seen a recession, we'll be talking from a perspective of we're now at the longest upward trending market cycle in the history of the market. And reversion to the mean dictates that cannot stay that way.
Well, to piggyback on the last slide, volatility will occur. Significant volatility will occur at some point. 20, 30, 40%. That historically has always happened in the stock market. We don't know when the rally is going to turn,
right?
But we want to be able to have a plan, and we do have a plan with our defined risk strategy for when that turns. Okay, so if this continues for 12 more months or 12 more years, we want to participate.
Right.
But when it turns, we want something in place that can help us avoid that big drawdown, that 20, 30, 40%.
Right. But it's interesting stuff just to see it. I don't think people realized how long it's been. Last slide here, and then we'll kind of wrap it up. When the markets do turn, when we do get the next recessionary period, and it could be triggered by a whole host of different things. It could be a dislocation caused by political turmoil. It could be a natural disaster. It could be an accounting irregularity. It could be corporate scandals. It could be a whole host of things. It could be terrorism. But when the market does take a break and it decides that we're going to all sit down on our wallets a little bit and be a bit more cautious as a society, and we enter a recession, the key piece of understanding this from an investor is limiting large losses, right? This chart here that we've provided shows something that a lot of people just don't quite fathom, right? If I'm an investor and I put myself in a portfolio where I'm targeting to make a good return, and but because I'm doing that, I may be subject to some potential losses. Let's say if I lost 5%, right? I'd have to make 5 or 6% to get back to whole. But if I'm in a portfolio that I could lose, say 20%, well, what I have to realize is I'd have to make 25% to get back to whole. But let's say I've completely forgotten that real risks are present, and I'm just going to go bore down into 4 or 5, real high flyer type sectors and be in a sector that I could lose 40 or 50%. Now I might make a lot as well till the cycle changes, but if I lose 40%, I have to make 67% on the other side of that to get back to where I started, or 50, I have to make 100. So if you think about the real threat to our portfolios for the long run, it's about not putting yourself in a situation where you're going to have to make 50 or 100% to get back to even.
And it's easy to forget that that's a real possibility when it hasn't happened in a while, since we're in the second longest.
Yeah, I mean, it hasn't happened on the mainstream investment vehicles, but I mean, obviously, it happened in energy 2 years ago. It happened in real estate in 2007. It's happened in technology. 10 years, like it happens, and it happens.
It happens
a lot
to
more than
the
we think
S&P.
about.
It happens to index funds.
Right.
It can happen to the broad market.
Right.
It doesn't have to be a tech stock that's in
Right.
bubble territory. It can happen to the broad index. So it hasn't happened in a while, but it can and will at some point.
And it is part of normal. It is normal that occurs every 7 to 10 years. So we just want to make sure that you keep focused on that. That is a cornerstone of what we're trying to make sure our clients don't have to figure out how they're going to recover from that, the way we hedge a lot of different things that we do.
Don't be shocked by it when it happens. Have a plan for it.
That's right. So we'll wrap up with a little financial market scorecard. Some things going on right now in the economy overall we think are good is that we have low unemployment, and those numbers continue to look nice. We have relatively low interest rates, and they're not really rising rapidly. I don't think we're going to see a quick raise there, and that's good for growth, good for spending, good for consumers. We have very, very strong global growth at the moment. How long it will last, we don't know, but at the moment it's very strong. Some bad things that are out there that we have to keep our eye on is inflation. I mean, it's going to become an issue that we have to deal with. Now, it may not be a bad thing from an investment standpoint, but it will change the psychology of decision making for a lot of different people in the world of economics. So we have to keep our eye on that. There is a lot of financial leverage. We didn't talk about it here, but the average S&P 500 company has now leveraged about 50% of their balance sheet is now borrowed money again. So anytime you get a lot of leverage, a lot of borrowed money working in the system, that represents risk. So it's between 45 and 50% again. It's kind of a high number. I'm a little bit alarmed about that. Elevated stock valuations. Schiller and those guys would say market's too high. You could argue there's other valuations it's not too high, but nonetheless, I don't think anybody would say it's cheap, right? So it is elevated to some degree, and then we just don't have a robust population coming into the workforce over the next 10 years. Our next 10 years of actual eligible workers, growth of workers in the U.S. is going to be less than 1% maximum. When you don't have workers to go out there and work, you can't expect your economy to produce double-digit growth. It doesn't add up. So that's going to be a challenge that we have to face for quite some time. So those are some things to keep our eyes on. We obviously appreciate the opportunity to work with everyone. We're excited that we're having a good year overall. We're excited that our portfolios are doing great this year. That's been a good thing. Sort of final conclusions is that even though slow growth is expected, some stocks may produce better returns in bonds, and we don't have interest rate risks the same way in stocks, so we're going to stay a little stock heavy right now. We need to continue to expect very slow intermediate term growth in the U.S. next 5 to 10 years. Population and other constraints are at work, so we're going to try to, I would say anything north of 6% would be a fantastic return in this environment, and we're going to try to do everything we can to keep our investors making returns that they can in as smart a way as we can, hedging out the bottom to the best of our ability. Global markets, hopefully they'll continue to improve. We'll participate there. We've increased our allocations overseas earlier this year. We feel pretty good about what we've got now in overseas, and we're going to stay diversified because we really don't know what will be the source for the next recessionary period. So those are the key pieces. Justin, did you want to add anything else before we wrap it up?
No, that's be prepared. It happens. It will happen at some point, so have a plan, not a hope.
No doubt. So we're going to do our Trumponomics session at the end of the month. It's going to be at the Cary Theater. We invite all our clients to come out, really want to dive into some of the Trump policy proposals and just talk about what areas of the economy that they would impact. And some would be positive for growth, some may not be. But we're going to try to take a non-political view of some policies that have been put out there and try to share some insight to you guys about what sectors of the economy might benefit or might be harmed from that. We're real excited about that presentation, put a lot of work into it. That's coming at the end of the month. And then in the fall, we're going to have our learning lab up and running again. And we've got some great classes for everybody coming up in the fall. So I'm going to wrap it up. I appreciate everybody's time today. If you have questions that you'd like to ask from today's material, just email myself or Justin, and we appreciate you. And with that, I'll turn it over to Justin for the disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.